What is up, everybody? We are working on getting going on Facebook, so let's get that up and running, and then we can roll. Perfect. We should be good there. All right. How's everybody doing tonight? Thanks so much for tuning in. We are just doing our thing over here, trying to get everything up and running. And we are going to talk about the 50-year mortgage tonight. This is kind of an idea that was pitched over the weekend, was all the rage, and now has lost a little steam. Imagine that. But we are going to dial that in, and we're going to get connected on Facebook, and we are going to be ready to go. So could you imagine paying your mortgage till you're 80 or 90? That's kind of something that was proposed, floated out by our president this weekend, and the internet exploded. Lenders and realtors and everybody was rushing to talk about all of this. And here's the deal. On a basic loan, the problem with a 50-year loan is that it is very interest heavy. You're going to pay, on a basic loan, throwing random numbers out here, 7.5%, $600,000 house, you're going to be paying $800,000 more in interest. Don't quote me on that. That's just kind of the basis of it. And so we need to talk about this. If you think a 50-year loan would help you qualify for your dream home right now, would you consider it? Go ahead and put something in the comments and let me know. But the honest truth is that when we step back and look at this, it absolutely is a costly endeavor and doesn't really help the real reason of affordability. So if you don't know, I'm Jeremy Kane. I sell houses in Northern Colorado and Denver at eXp Realty. And I'm all about the market. I'm all about building long-term wealth through real estate. And if you are considering getting into a home or whatever, please reach out. I don't even care if I'm your agent. That would be cool. But let's talk about this, because there's a lot of things going on that people are saying, oh, this is going to solve affordability, or this is the worst thing ever. And the truth is, the answer is probably somewhere in between, or maybe skewed to it's probably not going to help a little bit. But we're going to dive into that. We're going to talk about that. And as we go, it's a thing, right? And affordability is a major issue in our world, right? In Colorado and Denver, Northern Colorado area, first-time home buyer is going to be looking at, the equivalent of $500,000, $600,000 mortgage, whether, you get a condo for $450 and it has a big HOA, whatever. You're looking at an equivalent of that. We're talking $3,000, $4,000, $5,000, $6,000 a month to get in. And so the American dream and affordability seems, especially for people just entering the workforce and maybe have some student loans and all of that, seems a little bit, out there. There was a little survey done and asked 600 people, and all of a sudden the first time home buying age is 40. I'm not willing to go that far yet, but there is a lot of stuff out there. And so affordability is tough, right? When the interest rates were 3% and our price appreciation was going up, the sellers were happy, the buyers were able to get in for a, affordable monthly payment because that interest rate was at rock bottom. Now that it's gone up to some would say normal levels, some say high, it's a little bit more difficult. So that's what we're really diving into today, to really focus on, okay, what are solutions, right? I'm here to tell you that I don't know the solution, but I'm going to throw some ideas out there. I would love to have conversations with you. But the most important thing, as I always tell my clients, my buyers, my sellers, and you on the social media platforms, your situation could be completely different, right? If a lender is throwing out there an interest rate, the interest rates are at 6.5 or 6.25, or realtors posting the interest rates every day, that's for one person. That's for a specific down payment range, credit range. And the truth is, yours might be totally different, might be better, might be worse, but they usually throw out a pretty perfect buyer scenario, buying a perfect detached home and all of this. And a lot of things come into play with condos and HOAs and all the things. You have a lot of different nuances there. So no one can actually just look at a camera and tell the general public what your interest rate will be. So don't let anyone do that. So here's the deal. The 50-year mortgage was floated. I don't know how much thought it was given by the president. Don't really care. But we have to look at this, and affordability is on their minds. So that's at least a positive piece for those of you that are looking to get into the market, feel like you might have missed the boat. Your time's coming. It's going to be okay. They're looking at it. They're working on it. They're throwing out ideas. But when Mr. Trump throws out ideas, people either love them or hate them, and then they just go wild with them. So as we've kind of gotten a little bit removed from that scenario, things have changed just a little bit. And so, they're not like, it's not like he's putting this into practice or anything like that. He's got plenty of other things to worry about. So the argument for a 50-year mortgage on paper, on the surface, for somebody who, doesn't understand the whole amortization and all of that, is that, okay, if you spread out the amount you owe over a longer term, you would owe less, or you would pay less per month because you have more months to make up that, extra payment. Well, with our 30-year mortgage and with all of the interest rate and all of that and how it amortizes out, a lot of interest is paid. We're talking to the tone of, 800,000 more, million more than you would pay on a traditional 30-year mortgage. We're not talking about the fact that likely if a 50-year mortgage was rolled out, the interest rate would probably not be that prime rate, would not be identical to the 30-year mortgage, because no rates are different. You get a 15-year mortgage, you get a better rate, right? The risk is less on the investor. And so that's where things kind of melt down, right? But let's, for instance, pretend that the 50-year mortgage and the 30-year mortgage was going to have the same rate. That's where the data really points to a lot more money paid. And I will tell you at the end of this, one specific buyer that this maybe would come into play for. But if you step back and you look at it, basically that's where it's at. The problem is that if real estate is used as a wealth building tool, the longer amortization and the more interest paid and the more upfront interest that you're paying, you're basically stealing from your own equity, right? So right now we have a steady appreciation, maybe a little bit lower than people would like in the Denver market or the Northern Colorado market, right? So you have that appreciation. When you buy a house for 500, it's going to appreciate 2, 3, 4% per year. Typically could go down, but we've seen pretty steadily, staying where it's at 2 to 3%. And then, so you have that appreciation. So that's helping build, equity in the home, because your home is getting worth more as the years go on, right? Again, perfect scenario, everything taken care of. You're doing the updates that you need to do as you go. You're doing all of that. No deferred maintenance. And then you have, a small amount at first, which goes towards your principal, a larger amount that goes towards your interest. But by extending the time period, you're going to extend the time where that principal buy down actually can make a dent. So if we have flatter appreciation like we've had, we go to the 50-year mortgage as an option, then it's going to take, here's the deal. Like your equity is not going to build up as fast because you're not going to have as much principal buy down, right? Not to mention, one positive and one thing that's floated is, oh, well, you could, if you spread it out over 50 years in Denver, that could drop the median home buyer's debt to income 3-4%, right? This is a number that they use. If you're max qualified, maybe you have some loans, you have some other debt, you have some credit card bills. The debt to income ratio is how much you make, how much debts you have. The new mortgage has to fit in under 50, 45%, depending on the loan type, for you to be there. So it would drop the debt to income, or the amount that was taken out, a little bit, right? Here's the deal. We probably shouldn't be shopping at the very top of our debt to income ratio, because ultimately if you're paying, you have 50% or close to 50% of debts, that doesn't typically add up well for a household. But those are the limits. That's what happens. So your debt to income ratio would be positively affected. You would have a little bit more buying power, 3 or 4% based on a traditional loan, right? So that's cool, right? It helps people qualify for maybe a little bit more house, maybe gets rid of some of that appreciation, scarcity and things like that. But at the end of the day, it's a problem. So here's what I'm going to do. I'm going to talk about both sides. I'm going to give you some things, and then we're going to, call it what it is. Probably will not come to fruition, but a politician said it. It could be something that could be used as a tool down the road. A good tool? I don't know. So here's the deal. Supporters say that the 50-year mortgage would help make homeownership possible. I get that as we push forward. Okay, cool. Claim one would be it's a lower monthly payment, about $350 per month on a $600,000 loan at 7.5% interest. $350 doesn't really buy you a run of groceries these days if you have a decent sized family. I'll tell you that right now from experience, right? It would be easier to qualify because the debt to income would be lower, right? More cash flow flexibility, frees up money for childcare and retirement and repairs, of course, right? So if you could drop your payment $350 right now, what would you actually do with it? Because we've been given free money in the past, especially during COVID and that kind of stuff. And what we're left with is a terrible, credit problem and, nationally low savings problem. Those two don't add up. We spend it, we're consumers, we blow it, whatever. So what would you do with $350 extra per month right here, right now, today? Put that down in the comments, and I'd love to chat further about that. So let's talk about the trade-off. What would it really cost, right? So this is where it gets concerning. All of that stuff sounds okay on paper, but when you look at the numbers, when you're talking about building wealth, when you're talking about doing all these things, we have to get a little bit more real. So for that same $600,000 loan with 7.5% interest over a 30-year mortgage, you pay $910,000 in interest. It's a lot of money. That's one of the worst documents that we have to look at closing, is if you made every single payment on time, first day of the month, and you held the same loan for 30 years, which is not common, you would actually pay this much. It'd be $910,000 in interest plus the amount of money that you bought the home for. On a 50-year loan, it'd be $1.7 million in interest. So that's a huge amount. We're talking $800,000, $900,000 more, and that's if you pay on the first day of the month, right? Most of you may or may not know this. If you don't pay your mortgage on the first of the month, it does add up, right? It's not late till the 15th, but you are paying interest on those days. So try and pay your mortgage payment on the first of the month so you don't get penalized. So that's a massive piece of information that we need to look at, right? So you pay 87% more interest, almost double, almost 100% more. And it would take twice as long to build that wealth because you're paying so much in interest. So after 10 years, a 30-year loan builds roughly $85,000 in equity on that same loan we're talking about. On the 50-year, it would be 30,000 less. So that would be 55,000 in equity. So that's where the principal buy down goes over 10 years, right? $85,000 worth of, principal buy down equity, so to speak, and then $30,000 less if you're talking about a 50-year because of how it's amortized. So basically renting your own home from the bank for a decade, right? And that's massive. Who now thinks that sounds worth it? Probably not, right? And then we have more decades to go. So let's talk about this. If we step back and we look at it, who wins? The big banks, big businesses. The real estate market doesn't probably do as well because now we have even more of a stress on the sellers because okay, we're going to try and overprice our house. We're going to try and sell it for more. We're trying to force appreciation. You have buyers who are like, yeah, I could get in, but what's that going to do for me? I have to be in this house for, 17, 18, 20 years before I even can try and refinance, or I can even take advantage of the lower interest rates or whatever. And, for a short-term situation, maybe it works for you as a tool. I'm not convinced, especially in our current situation where we have a ton of seller concessions being offered and rate buy downs. It wouldn't take a massive rate buy down on a 30-year loan to eat up that $350 per month that you're saving. And so that's what some of the proponents and the people that I trust and know are talking about is hey guys, yeah, it looks okay on paper. Yes, extend it out. That's great. we're not talking about the interest rate, the interest that's going to these investors, it's going to these big banks, and that's a major problem. So the people it's supposed to help, the first-time home buyers, the low-income buyers, but it only puts them in like this box, right? And you've heard me talk about affordable housing and the government programs and how broken that system is on this channel before. But like, are we really building equity? Can we really call this a launching point for our, American dream and getting into the dream home eventually? It's going to take a lot longer than you think, right? So then let's look at history, right? This isn't the first time we've tried to fix the problem, right? Creative loans have come. In the late 70s and the 80s, the rates hit 18%. Did we create 50-year loans? No, we used ARMs and buy downs and shared equity programs. Some of those were great. Some of those ARMs, like some people still are a little scared of the ARM, the word ARM, adjustable rate mortgage. Because if the market doesn't go exactly as planned, if something happens, if there's a national event, if whatever happens, and you can't get out of that loan that's automatically raising that interest rate, then affordability becomes a major problem, right? Even the 30-year mortgage was born during the Great Depression, right? An innovative tool to provide the opportunity. And so, yes, we've always adapted. We've always built something up. We've always done those things. But the question is, like, we've never doubled the timeline, right? We've never taken 2/3 of the timeline, just put it onto the end. And so that's a huge deal. So it's not necessarily as innovative as you would think. And if we're pushing people into this and people don't understand exactly what's going on, it's a big deal, right? And the scary part is there's people in the industry who are like, oh, the 50-year loan affordability's fixed. Like, we're ready to go, right? And they're putting it on socials and they're talking about that. This is not the goal for that. So who is the one person that helps? The lifetime renter who is always going to rent and always has to create that, they just want to control that, right? They've been in the same house for 10, 13, 15, 20 years, right? We won't say who it could be or anything like that, but I have my thoughts, right? If they're only going to rent and then they have this opportunity to get in at a lower mortgage payment, maybe that helps, right? They don't necessarily care about the equity because they're always going to rent anyways. So they're going to stay there forever, right? Maybe not the best outlook on life, but there are people that are like that. They're like, this is my forever home. I don't care. I just need this. Like, I don't need anything greater. That's fine. But the 50-year mortgage could, provide the opportunity for them to get in if they don't have the cash to buy down the rate, if, the seller concessions aren't there, things like that. That is the only group of people that I can even fathom this being something that they could use, right? Other than that, it's a tool that we probably shouldn't be pushing, in my opinion, or even talking about. So it's not new, right? Other countries have tried this. In Japan, they've had a flat 50-year mortgage for years, but only if you're in your 20s, right? So they put the age limit on that. Obviously, we wouldn't do that, can't do that. You can get a 30-year mortgage on your 100th birthday here in the United States, which is fine. That's great. In the UK, they have 40-year mortgage. They tripled in popularity since 2021, by the way. But experts even call them like a long-term trap. It helped people buy, but it didn't make housing any cheaper. And that's the problem. Like, the rich get richer kind of here, because more borrowing power does lead to higher prices, right? If more people are qualified and more people are out there, bidding on homes, and the prices go up, and you eliminate any savings you might have had anyways. So that's how inflation wins every single time, because supply and demand, if it pushes, then it goes from there. So talking about Denver, here's what it means in Denver, Northern Colorado, right here, right now. Yes, it could make the monthly payment look better on paper. It would take you almost 17 years to build 20% equity, right? Why do we talk about 20% equity? That's when, the first-time home buyers, the lower down payment loans, can lose the mortgage insurance if they're conventional, right? If they're FHA, you're in it forever, and it is what it is. You have to refinance to get rid of that lifetime mortgage insurance. But 80-20 loan to value is a massive step, right? What that also does is allows you to probably look at putting 10, 15% down, a little bit more down on that next house, because it's typically a move up. So 17 years to build that equity is a scary, scary thing, to get just 20% equity in the home. And so that's the key problem, right? And that's 17 years before you can move that money, right? Before that monopoly money becomes real. And so one job loss, financial stress, all of these things that could come up, and you're in trouble. So that's a long time to be at the mercy of the market, the bank. A lot of things can happen in the market. The market could change. We could have a little bit of a recession. We could have a lot of different things. And so we really have to make sure that we are focused on the long term here. And like I said, you're going to be in your house forever. You're never going to move. You're solo typically, because usually when we bring other people in, changes happen or whatever. And so that's where we want to make sure that we're really focused. So a 50-year mortgage might sound like a creative fix, but it certainly doesn't solve the problem. And supply is the problem. We need to be able to build houses for cheaper so that we can sell them for cheaper. And that's something that, as you know, everything's more expensive. So we don't need longer loans. We need more homes. And maybe we could use some of this brain power to kind of create that piece, because if we increase the supply, then the demand is flattened out. Now, is that great news for, homeowners and stuff like that? Well, here's the deal. If you've owned a home since 2022, you've had a pretty good run here. So you are kind of playing with house money here, and maybe we don't need to make 15, 20% on our investment every single year, but that's beyond the point. So it's not the path to ownership. It's not the path to wealth. It's just the path to paving lifetime debt, right? And if you know anything about debt, kind of sticks with us. Once you're on credit cards, you're paying interest, and you're getting behind, like, it just makes it harder to get caught up. And so it's really no different. You're paying a ton of interest. Now, again, if you're a lifetime renter, you want to buy a place, this is the place you're going to die in, that's fine. But how many of us really have that kind of outlook? Not a ton of us. And that's the point, because this could be used and could be pushed for affordability and all the things. I mean, I kind of compare it to when the loan limits raise. Okay, the FHA loan limit just raised, like it's in the 800s or whatever it's at now. Well, 3.5% down on an $800,000 loan is not something that's a very comfortable payment. So yes, we can afford more because the loan limit went up, but like, can we really afford more? Can we really afford that extra $1,000 on top of that mortgage payment? I don't know that we're at that point. So let's talk solutions, right? So if affordability is a concern for you, as I said earlier, there is a ton of options here, right? With the concessions, how our market is, right? I was building concessions into my offers and everything, even before, like when it was super competitive. At the end of the day, seller doesn't really care about concessions. They care about their net proceeds. And so if you can work it out, you can get that appraisal, the higher amount, concessions, whatever. We had to get really creative when we were getting competitive, but there were still concessions, right? And at the end of the day, the net's the net, and we go away happy. So that's huge, right? Down payment assistance, right? This is something that's in place. You have DPA programs across the country, different states, different counties, different everything. And down payment assistance programs, in my opinion, are fairly risky, right? Because you're getting into something, it's your first house, usually it's a younger, whatever, you're at that point, at that stage, whether you're young in age or not, and you have this new investment, right? And it's usually a little bit more expensive, and it's usually going to break. And, if we're in down payment assistance and something happens, divorce, death, job loss, whatever, which is typically job loss, especially maybe some divorce, is a little bit more likely earlier on in your career in that first time home buying kind of platform. And so if you're in a down payment assistance loan and you have to move, you have to relocate for a job, or, you break up with your significant other or whatever, you're buying a house pretty much 100% leveraged, right? So the money you put in, for closing costs and whatever, that's gone. So you're technically underwater, before you even start, especially in a flatter appreciation market. Got away with this in the early 2000s and stuff when the, appreciation was going up so quickly that, yeah, if we made a mistake, we could probably sell it within a year and at least break even with the fees and things like that, because we were appreciating so quickly. But now it's not necessarily the case. So that's one thing. If you do own a home, you have opportunities for HELOCs and things like that you can utilize that. Obviously, multi-generational living is a thing now. So these are all things that kind of we have put in to help with affordability. They fix the problem? No. We need more houses built for cheaper that are affordable. And, you know, that's a whole other issue. And I don't think the 50-year mortgage is the answer. So we can get creative without doubling your debt, especially right now with the market how it is and concessions and all of that. So before, if someone's talking to you about a 50-year mortgage, if it does come to fruition or 40 or whatever happens, like let's have a conversation. I don't care, whatever. I'm just here to help you and help you understand there are other options, right? Is this truly your only option, right? If you have to buy a house right now, for some people it will be. But what if we did XYZ over the next 6 months and go from there? So I'm here to tell you, I was looking at a loan estimate the other day, and one of my clients is going to pay like $500 a month in mortgage insurance because of that, right? And all the difference was from 713 to 720 credit score. So that little difference can make a massive change in your, mortgage insurance and all the other things that are added on, right? Because a 50-year mortgage with a low down payment is going to have mortgage insurance. It's probably going to be super expensive. So yes, on paper, if the interest rates were the same, which they won't be, like we're going to have other factors that come into play here that raise that mortgage payment, probably eat up that savings anyways. So if you're trying to figure it out and buy without getting buried, let's have a conversation. I specialize in building equity through real estate to help you make a plan. It might not be your dream home right out of the gate, but that's what it is. So affordability is a real crisis. We need to work on it. We need to have certain things to do. I just don't think a 50-year mortgage or an extended amortization schedule is something that should be the first step. So drop a comment if you feel, in any way, let's have a conversation. And then obviously call and text me. If you have a specific situation, like, hey, this 50-year mortgage, is this a thing? Yes, it's not a thing, first of all, right now. But it does come to fruition or anytime. Let's have a conversation. Let's make a plan. And let's make sure that you are setting yourself up for success, because at the end of the day, that's all I care about. Like, comment, subscribe, and we'll see you next time.